Have you ever stopped to think about how one single event happening thousands of miles away can actually reach out and affect your wallet, or the stock market, or even the decisions made by the most powerful banks in the world? Well, today, we're going to trace those connections. We're going to follow the shockwaves from one geopolitical conflict and see exactly how they ripple through the entire global economy. To really get a sense of how big of a deal this is, just look at this number. 1 out of 5. That's the geopolitical risk rating that analysts gave to a potential U.S. military conflict in Iran. On a scale of 1 to 5, 1 is the absolute most severe. We're talking about a major disturbance with a serious threat to the whole world's economic stability. And this idea right here, this is the core of our explainer today. We're calling it the ripple effect. We're literally going to follow these waves as they spread out from a single point, and you'll see how they touch everything from how we feel about the economy all the way to the actual cash in our wallets. So every ripple has to start somewhere, right? It has an epicenter. And in our story, that epicenter is the geopolitical shock itself. That's the conflict that kicks everything else into motion. Think of this as ground zero for the economic earthquake we're about to explore. All right, let's follow that first and most immediate ripple, because before it hits the markets, before it even shows up at the gas pump, the shockwave hits us, right here. It's all about how we feel about where the economy is headed. That's exactly right. The very first impact isn't really financial, it's emotional. All that uncertainty about what's happening in the world just makes people, well, nervous. And what happens when consumers get nervous? They get cautious. They stop spending. And that is a huge driver of the entire economy. And listen, this isn't just some vague feeling in the air. We've got the data to prove it. That number you're looking at, 55.5, that's where the University of Michigan's Consumer Sentiment Index plunged to right after the conflict flared up. It's a real, tangible measurement of that psychological ripple hitting the shore. Okay, so after that psychological hit, the next ripple is a lot more concrete. This is the one that most of us feel directly, whether we're filling up the car or we're at the grocery store. We're talking about rising inflation. And here is the connection, plain and simple. A conflict in a major oil-producing region immediately puts a squeeze on energy supplies. And the result? You guessed it, higher prices at the pump. It is the fastest, most direct way a geopolitical event translates into a real-world cost for, well, pretty much everyone. But the danger here is actually way bigger than just gas prices. The real fear is that these higher energy costs start to bleed into the price of everything else. And that changes our expectations about where inflation is heading. That could cause what experts are calling a renewed inflation stall. Basically, inflation stops going down and just gets stuck at a really high level. And that's a huge problem. So, from consumer prices, the ripple keeps spreading. And now it's crashing into the financial markets. And here, the effect gets a bit more complicated, and it creates a very specific kind of danger for anyone who's invested. This brings us to a fascinating concept called asymmetry. It means that the potential for a really bad outcome suddenly becomes way greater than the potential for a good one. See, these kinds of shocks don't create an equal chance of stocks going up or down. Nope. They heavily tip the scales toward a sudden, sharp drop. And this seriously increases something called tail risk. And just so we're all on the same page, what exactly is tail risk? Think of it as the danger of some catastrophic, super unlikely event actually happening. It's like the financial version of a meteor strike or a 1,000-year flood. You know it's probably not going to happen, but if it does, the damage is devastating. Well, geopolitical conflicts make that meteor strike just a little bit more likely. So all of this, the fear, the rising prices, the shaky markets, it all leads us to the final ripple. And this one reaches the very highest levels of economic policy. How does the U.S. Federal Reserve, the institution that's basically in charge of steering our economy, react to all this chaos? They pump the brakes. I mean, with so much uncertainty floating around, you've got falling confidence, rising inflation risk, nervous markets, the Fed gets really hesitant. They can't be sure if their next move is going to help or just make things 1,000 times worse. So the smartest play for them is to just wait. They wait and see and gather more information before they touch interest rates. And we don't even have to guess about this. The Fed has been pretty open about it. They've literally said that the implications of the conflict are still uncertain. And that's a huge reason why they've decided to keep interest rates high. They just aren't convinced that the fight against inflation is really over yet. Okay, so we've traced all 4 ripples, from the initial shock all the way to the Fed's reaction. So now for the big question, right? What do you actually do with all this information? How does all this uncertainty change how you should think about investing? The main takeaway is really clear. This is not the time to be making huge, aggressive bets in the market. A risk-on strategy where you're piling into high-growth, speculative stuff, well, it's just not a good fit for the current conditions. Right now, caution is the name of the game. So what does being cautious actually look like? Well, this slide breaks it down. On the left, you've got what's less favorable right now, which is just broad exposure to the whole market. But on the right, that's where you want to focus, on quality. We're talking about companies with rock-solid balance sheets, margins that can hold up under pressure, and the ability to consistently generate cash. Why? Because these are the businesses that can handle higher costs. They can weather the storm. It's about playing defense, not just offense. And that all brings us to the key phrase you should remember from all this: cautious and selectively constructive. What does that mean? It means you don't panic and pull all your money out of the market. Instead, you stay invested, but you get incredibly picky. You look for stability, you look for resilience, and you build a portfolio that can handle these ripples of uncertainty. And that really leaves us with this central challenge of navigating a market like this. In a world where one single conflict can send shockwaves absolutely everywhere, it's all about a delicate dance. It's not just about avoiding risk, it's about finding strength within that risk. So the question to really think about is, how do you balance that need for caution with the constant search for real opportunity?